Joy Dutton. I'm a hard money lender, private money Utah. I'm got a special guest with me today, Blake Reese, who is a 30-year mortgage professional, is actually one of my mentors when it comes to mortgage stuff. My go-to guy, loans for me, loans for my friends and other investors. So I brought Blake Reese on today with me to discuss the traditional mortgage lending side of the current state of lending under the new pandemic that we've been all dealing with. Blake, how are you doing today?
Great. It's good to talk to you.
So I think we wanted to, oops, make sure I have, can you still hear me good?
I can hear you.
Okay, we wanted to go through some questions because there's a lot of questions that everybody has out there that we feel aren't getting answered. We have a lot of people that are sharing their opinions and we don't know where they're getting their data from. So what we wanted to do today is we wanted to share our opinions with you as experts in the lending world. But these opinions don't necessarily reflect the companies that we work for or any of the employees that work for those companies. Those are just opinions of us from us as mortgage professionals.
Yeah, I think that's important. I mean, it's a kind of a crazy time right now, and a lot of things we don't know. So it's important to know that these are just kind of the things that we've been thinking about, ruminating over, and our opinions as to what's happening.
And then Blake, do you want to get a little bit closer to your mic just to want to make sure that
Is that better?
hear you okay? I think that's great. Well, guys, the first thing that we wanted to talk about is there's a lot of rumors circulating that certain loans are on hold. And we have two major loan types that are on hold right now. And I'm going to let Blake go into a little bit more detail on those now.
Well, I would say, and once again, just as a reminder, things are constantly changing on a day-to-day basis. So one of the loan types that we know are on hold right now are our non-QMs. Basically quality mortgages. It's basically anything outside the Fannie, Freddie, or government spectrum. And there's a lot of speculation as to why that is. And to give you maybe a little bit better idea of what that goes to the heart of is loans that we're using bank statements for income on non-owner occupied, sometimes no income documentation on investment loans. There's a number of other kind of niche-y things that market did, but as of about 3 weeks ago, we got a call on a Friday morning and said, we're shut down. We had several loans that were ready to fund in that venue that just got caught up in the nebulous nothingness of what that market is right now. And so our understanding is that some of those lenders may come back in about 15 to 30 days, and then there's some talk that maybe they're gone forever. We don't know. And what it is, it's a liquidity issue from what we understand. So they basically have no money to loan out. They can't get rid of their lines of credit, so they have no money to loan out. That's basically what our understanding is. And then also our zero down programs have been impacted dramatically. There's still work, like Utah Housing, for example, zero down. Utah Housing is still funding. We've had some issues with locks on a daily basis. So there's been a lot of impact in that zero down marketplace as well. It's still functioning, but barely.
And then when you say jumbo loans, we hear that the larger size loans are really hard to get if they're being made at all. And when I say jumbo loans, Blake, what does that mean?
Well, to get some clarity, there are 3 counties. You have conventional conforming loan limitations, which vary by county. Normally, those go up into the high 300s or low 400s. And then you have what's called high balance conforming, which goes up to 600,000, 300. And then in 3 counties, which is Tooele, Salt Lake, and Summit. Once you go beyond those 3 counties, or if you're outside of those 3 counties, then you're automatically considered jumbo. And if you're above that 600 threshold in those 3 counties, then it's considered jumbo.
And
so
what is that? I mean, so what the rumor that's going around is those jumbo loans are just not available. They're hard to get. There are a few lenders that are still doing them. What's your take on that?
They're harder to get. I mean, they're still being done, and I think maybe somewhat like the no down payment loans. It varies by lender. There's a lot of different lenders out there with a lot of different lines of credit, investors. So it varies widely. But I can tell you that my understanding is mostly that that market has been constricted greatly. So to give you an idea, J.P. Morgan came out at the end of last week or early this week, basically saying, "Whoa."
Hey! Oh, that's fun.
Fun parts of Zoom home videos. Anyway, I guess I'll keep going on the jumbo part of it. So about the end of last week, beginning of this week, JP Morgan Chase came out and said that they're revising all of their guidelines to a minimum 700 FICO score and a minimum 20% down payment or equity position. So that's huge. I mean, that kind of goes back to like the days of our parents, where they were saving up 20% for a down payment. So they still are. There's a few lenders out there that are still doing jumbo, but you can pretty much expect that those FICO scores need to be really high, and the equity position needs to be minimum of 20%. That's what we're seeing across the board with those jumbos. Whereas I would say, before the whole coronavirus thing came out, we had loans that went all the way up to 90 or 95% on jumbo.
Perfect. Okay, now we kind of touched on this already. Our lenders, have they tightened up their requirements? We saw a press release that was released this week earlier by JP Morgan saying that they're requiring larger down payments and higher credit scores. What is that? Is that happening?
Yeah, across the board, I think, you're seeing, once again, a lack of liquidity, kind of a Reader's Digest version in our markets. One of the things that helped tremendously, I don't know if you remember, but about 2 weeks ago, the Fed had an emergency meeting that they had on a Sunday. A lot of people were wondering why they couldn't wait until Wednesday, where they had originally planned to meet. And the reason is that they were awfully worried about our markets imploding. And so on that Sunday night, they promised to inject about $70 billion worth of capital into the Treasury system and into mortgage-backed securities to buy those, provide liquidity. And so once again, who knows what was really happening, but this is we suspect that they were heading off a fall off the cliff from lenders being able to lend at all.
Wow. That and so that being said, so are you seeing, you said higher credit scores? When I talked to you earlier today, you were talking about higher credit scores, more cash reserves, and larger down payments.
Yep. So really what that's spurring is, the Fed, that the injection of money from the Fed is really helping out a lot of our kind of vanilla based loans. So the ones that are most stable right now are 30-year fixed rates, super vanilla. We haven't had prepayments for a lot of years, adjustables, no way right now. And even the 15-year loans, you would think that 15-year fixed rate standard amortization would be a pretty easy loan to do, but even those have been suffering for liquidity, and investors just don't want to buy those. So there's not a lot of liquidity there. So we've seen interest rates even higher than 30-year fixed rate mortgages recently because there's just no palatability for those loans. And then back to your original question, when it comes to, credit scores, investors are also worried about forbearances right now, where a lot of, you've got, scores of people that are in trouble financially. So they're asking for forbearances on their mortgages. Well, when the investors are not getting paid that money in the secondary market, they get really worried that, that their yields are not going to be where they need them to be. So yes, on all new programs right now, they're super worried, especially in the low down payments sectors. They want to see higher credit scores. In fact, a lot of companies have gotten rid of a couple of buckets that used to be there on FHA. We had a 500 to 580 bucket. As far as I know, that's been pretty much eliminated entirely. I don't know anybody that's doing that one. Although there may be. I mean, of course, there's a lot of lenders out there, but my understanding is most have gotten rid of that bucket. And then there was another bucket from 580 to 620. And I would say most of the lenders I know of have gotten rid of that bucket as well. I do know there's a few still out there doing that, but it's kind of rare. And then most of the lenders right now have put a minimum standard, even for the government loans, at a 620 or 640. So, and that's minimum standard. When you get up into the conventionals, they're wanting to see 680, 700s, especially on those jumbos.
So credit scores have increased, more cash reserve requirements,
Yeah.
larger down payments.
Yeah.
And that's going to be on the traditional mortgage side, guys. That's what I wanted to reiterate. That's what we're talking about right now, is the traditional mortgage side.
Yeah.
Blake's touched on an important point here: forbearance, and how can it affect credit scores. We don't know the answer to that yet, and nobody's giving anybody any information about that. Does it stay on the report? Nobody knows at this point. And how will that affect people's ability to obtain a mortgage later down the road if they did go back to work and they had a forbearance on their mortgage, or any other lates on their credit report from any other consumer debt that reports to credit bureaus. So that's something that Blake and I had talked about earlier today, that is just still a big unknown for everybody out there.
And I would be very careful, though, if history is gives us any insight into this. We know that the post 2008 financial markets had very little, offered very little help to homeowners post problems, right? So anybody who's requesting a forbearance right now or skipping payments, I would advise you to be very, very careful to sit down with your you're going to sit down, of course, but to get some great clarity with your current servicer and make sure that you understand everything that goes into that forbearance. Because the word on this, if history has taught us any lesson, there's a lot of times where they're not going to be very kind, and a lot of times we've seen on the credit reports from our three bureaus, the actual wording forbearance. And, so we have a loan right now that's got that on the credit report, and we're having to be very careful how we move forward on that one. So I would say be very careful about entering into forbearance, and make sure you understand all the terms. What I'm hearing right now in the marketplace specifically is that most lenders are either allowing for a short period of time where you're not making those payments, but most of them are requiring that amount of money gets made up either immediately after the forbearance ends, or on a graduated scale for 6 months to a year afterwards. But either way, you're going to have a pretty big debt that's coming due at that time, at least from all from what we can see right now. So I would be very careful. I don't think they're going to treat it like they do the annual holiday payment you get for your auto, where they send you the little thing on Christmas and say, hey, how would you like to skip your car payment? We'll just put it on the end of the loan. Everything's great. It won't affect your credit. I'll be very careful not to look at this like that, because I think most servicers are not going to look at it that way.
Correct. I agree with that. I think that, I guess that leads me to my next question. So we were just talking about forbearance, how it can affect credit scores. Will people be able to get a loan in the future if they do a forbearance on their mortgage? That still remains to be seen. But one of the questions I wanted to ask you, Blake, is, so you've got all these buyers that are approved, they've come to you, for a mortgage. They've not come to you necessarily, but they've come to your company and they're seeking a mortgage, and they want, they've been approved. They've been approved for a certain amount based on their current employment status and their credit score. So now let's say that was 4 weeks ago. They're looking for a home. They've maybe had a couple homes under contract. They fell through. Now they're unemployed. One of the two of them, let's say it's a married couple, is unemployed. How is that? Have you seen that cause some loans that were approved previously to fall out?
Yes, absolutely. In fact, that's one of the things that I think people need to be the most cautious of right now. I know at least our company is requiring that we do a 24 to 48 hour verification of employment just before we're closing and funding, to make sure that our clients still have jobs. Of course, nobody wants to put a client in a position to have to make a mortgage payment where they don't have a job or income. So right. Obviously it's there to protect our clients, but sometimes it stings a little bit, because if the job is gone, then, obviously we're in a space where we may have to wait for a while to actually start funding. And frankly, we do have some clients that are in that position right now where they're waiting for calls to come back to work. They don't know if or when. And the better part of our wisdom has said, look, let's wait till these people get back on the job, feel stable in the direction that they're moving, whether it's a refinance or a purchase. Make sure they feel stable moving forward, that this is kind of behind us, and that the income is, for their foreseeable future, going to be steady.
So, Blake, I mean, hearing you talk, I'm drawing some conclusions of my own. But one conclusion that's kind of just jumping out at me, and again, it's my own conclusion, my own personal opinion, is that a lot of people that were eligible for financing to purchase a home now may not be eligible for a couple of reasons. Maybe they fell into the jumbo loan category where they're looking to buy a higher priced home and now they don't have that jumbo loan product available. Or maybe they're a bank statement borrower where they're not going to be giving tax returns to a lender. They're going to be giving bank statements, which would fall into the non-qualified mortgage category, which, as you mentioned, a lot of those loans have gone away, or at least they're temporarily gone. And then the unemployment status. A lot of people have been laid off or furloughed from their jobs, and now they have that unemployment status. And we all know that the last thing that a lender's going to do before they fund a loan is they're going to verify that employment one more time. So my conclusion that I'm sort of drawing from that, as again, my opinion, is it's sort of shrunk the buyer pool, the eligible buyer pool.
Yeah, I would say absolutely. I mean, it's something we have to be, very cautious of. And certainly, yeah, if you were approved 6 weeks ago, 8 weeks ago, probably get in touch with your lender and, re-up the documents and make sure that, that the information you gave them is still valid. And especially when it comes to income, the credit scores, maybe not so much. I mean, we've actually seen, unless you've done something like enter into a forbearance. And of course, if you've done that, then you certainly want to talk to your lender and make sure that they're going to be okay with that. But frankly, Corey, I would make sure that if you're going to make a move, I've had a number of my past clients call me and just say, hey, Blake, I'm thinking about doing this forbearance thing. What do you think about it? What's your advice? And I'm telling them to make sure that they look into it, because I don't have the answers to what our secondary marketing servicing is going to do with those loans. But be very careful, because if it does affect your credit, then you may have to live with that for a long time.
Well, and that's kind of what you were saying earlier, is about we talked about is that we don't know how the forbearance is going to affect credit scores.
Right.
And it's still TBD. And so that's another factor that could potentially shrink the future buyer pool, because if somebody does go into forbearance, and let's say it does affect their credit, or they're not able to pay certain bills and those affect their credit during this time, that would shrink possibly a future buyer pool. When I say that, I mean in terms of eligibility for financing.
Absolutely. And I think that goes across the board. We're looking at, the major parts of where we qualify people, their assets. People are, assets are dwindling because a lot of times they're having to supplement their, normal income and take money out of savings. Their credit scores, theoretically could suffer from lack of making the monthly payments on time, and, or, like you said, maybe going into forbearance. Credit scores are certainly an issue. And then obviously the last piece is income. That's the third piece that we look at, and income is, obviously has to be there. And once again, it's not punitive, on our parts. We're not trying to, obviously we're here as lenders to try and help as many people as we can to help them to reach their goals and to maintain their lifestyles. But obviously we don't ever want to put people in a bad position where, they're starting out looking at failure right out of the starting gates because their income has diminished or gone away.
So my takeaway from that is, if you're a real estate agent, if you're a potential buyer, get in touch with your mortgage professional and tell them, here's what's changed. If anything, how does this affect my ability to qualify for a mortgage? Because there's no point in continuing to look for properties or look for properties for your clients if you're a realtor, if they're no longer eligible, because it's just a frustrating process for everybody involved.
Absolutely.
Blake, I want to, what I want everybody to know here is that Blake's not just an outstanding mortgage professional, that my go-to guy for mortgage, but he is also an investor himself. In the previous, leading up to the previous financial crisis of 2008, Blake was an active real estate investor. Blake, I wanted you to talk about, what did you have going leading up to the last financial crisis?
Well, I kind of started out early. I remember just going through college, I was fascinated with real estate. I don't remember if you remember a guy named Dave Delgado. This is going way back. It dates me, but he was a real estate investor coach, back in the day that, did seminars and stuff. And I've always been fascinated. And I realized that, real estate always has been and always will be an important part of a real estate or of a retirement plan or a retirement portfolio. And to that extent, through my early years in college, I built up a fairly substantial real estate portfolio. And as we got closer to 2005, 6, when things were going really well, a lot of people were getting very aggressive in real estate. And, we saw there was a lot of big numbers coming out, and to a small extent, I got swept up in that, unfortunately. And so we learned tough lessons in life. I had some great successes. I sold a lot of my properties for a lot of money, and that worked out nicely. Just preparatory to the 2008, though, I had purchased a number of larger properties with higher end tenants. I had at any given time between about 10 and 15 properties. And when 2008 hit, the faucets turned off, as you know, in lending. And they also, the other impact, which, if anybody's investors out there, the greater impact is people unable to meet their rent obligations, right? And so as investors, we think that, oh, well, I'm going to buy this house, I'll get a renter in there. Worst case scenario, they might be gone for a couple of months, but I can weather that storm, and then I'll get another renter and I'll be fine. I can cover that payment. But there have been times in our history, 2008 amongst them, that the tap shuts off entirely overnight, and values dropped precipitously. There's no way to sell. And then, a lot of times in those times of tumultuous economic times, the tenants are not able to make their payments either. So I've got a good friend of mine who has 4 properties in different places all over the world, doing great up until just a few days ago. I talked to him, and he told me that all of his properties are empty. So, and now for the foreseeable future, empty, we don't know. So I would just say, if we're talking about investing, be cautious, be cautious when you're, how many properties you're purchasing, be cautious about the price points. And I think, Corey, you and I talked a little earlier about making, doing your best to try and keep in the middle class affordability space, because people need houses. And I know I told you a couple of things I learned through the 2008 meltdown. But the most important thing I learned was that houses cannot appreciate past the middle classes of ability to afford them. And I think that's it's extremely prescient right now to remember that, because once it goes past that, there's a limited group of people vying for those homes. And then, as investors, not only just, as personal private investors, but also as businesses, we have to be very careful about that. So,
well,
yeah.
And you said earlier when we talked that I wanted to bring up is, you were saying that we have, a very limited number of people that can, buy, because basically wages and salaries have not increased enough to offset the increase in prices that we've seen over the last 8 years, right?
Correct. Yeah. The only thing that we've seen driving that is demand. And, Utah's experiencing a huge influx of new home buyers from out of state. And then, of course, we tend to populate the state quite well with our own population. So it's been growing. And it's created that demand. And the demand is what, frankly, I think is what's held those, once again, it's my opinion, what's held those prices high.
Well, I mean, so, and one of the things that I see, I'm one of those people that I'm going to go and I'm going to read the reports. I'm not just going to take a quote or a statistic from a report. And one of the biggest reports that I always hear cited is this demand report, supply and demand for Utah. And the funny thing about that is there's two major aspects that I want to point out. The first is that they include everybody in that category that is over the age of 18, that is not in jail, and that is over the age of, I think it's 72. Don't quote me on that. But we both know that not all those people are in a place where they're eligible and or ready, or in a place in their life, right, to actually be a buyer. They may need a home and a roof for their head and a place to live, but they are in no position to buy. So I feel like people, they take those numbers of, supply, demand outstripping supply by, 3 years or whatever they're saying now. But if you really go and look at those reports, you'll see where they're coming up with those numbers, and they're extremely skewed. The second thing I want to bring up is now, for all those buyers that are really true buyers that are eligible and they're willing and ready and able to buy, how many of those now are actually eligible because of all the things that we discussed? Some of them can't qualify for qualified mortgages, so they fell into the non-QM category, and now those loans aren't available. Some of them are in the jumbo category, and now those loans haven't been readily available. And then some of them are they're unemployed now, or they've been furloughed or laid off, so they can no longer qualify. So my big thing that I'm always kind of preaching is, don't go off of these crazy numbers that people throw out there about there's an endless demand and just such a small supply. Because what I will say is there is a very large demand for affordable homes in Utah below 350, but let's just face it, there's not a lot of them.
Yeah, and becoming less and less as time goes on.
And then you mentioned to me when we talked about the other day, earlier today, we talked about some takeaways from the 2008 financial crisis that you had. And if there was one major takeaway that you took from that, as not just a real estate investor yourself, because you were at the time having had 10 plus homes, but also as a mortgage professional, if you had to give me, say, one big takeaway from that, what would it be, Blake?
Warren Buffett said, be greedy when others are fearful and be fearful when others are greedy. I think from an investment perspective, that probably would serve you the best, serves all of us the best. I think what happens is what I've seen in my career, in my lifetime, is people get swept up and we're like cattle heading off the cliff. And I think we've seen, a little bits and pieces of that with, the panic that's been seen around this coronavirus. I posted earlier at one point in the beginning, it's like cooler heads need to prevail. We need to be thoughtful. We need to look at the science. But for sure, let's not lose our heads. Let's not lose our cool. Let's not go off and, do things that are part of the cattle stampeding off the cliff. And when it comes to, investing, I've seen it over and over again where people get caught up in this gleeful party of lots of money flying. Feels like the Wolf of Wall Street for people sometimes. And, when times are good, but, you have to understand that life is always, our market's always going to fluctuate. It's always going to have its ups and downs. So, sit tight through. I had a great talk with my financial planner the other day. And, the people that are prepared for things like this use their money wisely, and the money they're using during this, for example, is not their stock money. The stock portfolios, have gone down in value a lot, but that's only, it's only temporary. And as long as you're not selling, it's not going to affect you. So to be thoughtful about, what's going on right now. And I think, if I learned one thing, actually, the two things I learned was, the Warren Buffett, and then the other thing I mentioned earlier, which is, property prices can't outpace the middle class's ability to pay for them. Because once that happens, these people no longer qualify. And in fact, the trick that that lenders were using, as you probably know, back in 2007, pre-crash, was to, we had that same problem facing us, which was, how do we get these middle class, borrowers into these higher priced homes? Well, they came up with these wonderful little tricks in the secondary market, and with the ninjas and the stateds and we'll just state people's income. If they can fog a mirror, we'll go ahead and let them sign on the dotted line. And that was the precursor to that. So it'll be interesting to see. I think, to kind of sum this up, it'll be interesting to see what happens now, because Corey, I see the same thing happening with our clients. There's an interesting kind of side note here.
Okay, yeah, please share.
I can just tell you, like, I being in the trenches, I keep my finger on the pulse of what's happening out there, and knowing what's happening with the majority of my clients at any given time. And we see these little patterns emerging, right? And the pattern that's has been emerging recently is the same one that happened just before 2008, which is people's incomes are staying relatively stagnant. They may be moving a little bit. We see the numbers, a few of the mid-level managers are making a little bit more. We see, some minor modest gains in the lower class, the lower income brackets, but just not much, right? And so what we see is that when we get in a time like this, it's the party time, right? Everybody wants to feel like, they're trying to keep up with their neighbors. They're wanting to live the lifestyle that they feel like they deserve. And so what happens is that they end up spending more money than they should. And then they wake up one day and they go, okay, well, I'm out of money. What do I do now? And then they go, well, look, I'll tap my equity out of my home. So the first thing we start to see is requests for home equity lines to pay off credit cards normally.
Or to tap into that perceived equity, right?
Correct. And by the way, as you know, in the last 7 years, we've had a lot of that. So people are feeling quite confident that I can go out and spend because I've got my little piggy bank I can go back to. So they go out and get the home equity lines. And then the next wave are people that have gone through their home equity lines and probably racked up the cards that they paid off with the home equity line. And now they're back. They want a loan to pay off the new credit card loans and the home equity line and their first mortgage. They want one loan just to consolidate everything.
Have you been seeing those?
A lot of them.
Wow.
A lot. So you just see that's the next step. We see this, and it's clear, crystal clear. We see it happening, and then the unfortunate part is if I could just give one piece of advice, it's like you've got to live within your means. You've got to live within your means, because when you step outside that and you start trying to keep up with the Joneses, when we do that, what happens is we go through all that equity in our home equity line, we get the consolidation loan, and then we wind up in the space where we were in 2008, where we're tapped out. The piggy bank has gone away, and now what do we do? And the answer to that in that time was, we're going to lose our house. And a lot of people lost their houses through that period of time. So, which was heartbreaking, absolutely heartbreaking. So I hate to see us repeat history.
Well, and last time, we had months and months to sort of prepare and, sort of climatize for the recession, that it didn't just necessarily happen overnight. I think there were a lot of warning signs that sort of led us up to the crash. And people had a little bit of time to prepare. But in this case, with the pandemic, we've had 2-3 weeks to prepare. And to prepare for what? I mean, something that nobody has ever seen. And so it's that uncertainty. You get a lot of talking heads out there that, are saying, well, this is what I think, sort of like what we're doing.
Yeah.
But I think what we want to do here is we want people to draw their own conclusions from some of the stuff that we're observing in the market and these opinions. Take what we're saying and formulate your own conclusions and make wise investing decisions for yourself. If you're a flipper and you're relying on a certain type of home buyer to be able to buy your property when it's fixed up, you need to think about timing. You need to think about pricing. You need to think about your buyer pool and all those things. And that's why we're putting this information out there for you, so that you have it available. I want to go a little bit further on that point, and I want to say that one of the conclusions that I've drawn from some of these these fact points that we've brought up about the jumbo loans going away, about the non-QM loans going away. And again, when I say go away, I mean they're gone now. They may come back. We don't know when. One of the conclusions I'm drawing is, I said there's a high demand for affordable housing in Utah under 350,000. So my personal opinion as a mortgage lender and hard money lender is I would say that we're going to see some price drops and some really slow sales in the 500 and above. A guy brought me a deal recently. It was 3 townhomes that he's looking to purchase in Salt Lake. The builder ran out of money, and these are luxury townhomes that he's planning to relist once the construction's completed for $750. That, in my opinion, is the area where we're going to see the biggest hurt and the biggest price reductions. Now, I could be wrong, okay? But what is leading me to down that path to those conclusions? Well, we already talked about the non-QM loans and the jumbo loans kind of going away for now. Those are jumbo loans, folks. Those fall into that jumbo loan category. The other thing that I want to say is, let's say you're a small business owner and you have a business right on Main Street and you've got 30 employees. Are you going to bring all 30 employees back on May 1st when the government says we can reopen everything? Probably not. So a lot of those 30 employees are going to be the ones that were going to be your buyers for 500 and above. So that guy that's going to try to sell those townhomes, he really needs to think about timing, and he really needs to think about pricing, and he really needs to think about the eligible, qualified buyer pool that is going to be buying those homes. Because I think if you're a flipper and you're targeting homes under 350, you're probably going to be okay, because we're going to see some pent-up demand, and a lot of those people are going to go to work right away, because those are the service level people that are going to go right back to work. The people that are buying those homes in the 500 to 750 to $1 million range, those are going to be your middle managers and people that could be possibly executives for companies that may never open their doors again, and or companies that are just going to bring on the people that are out on the street performing the services, the service-based employees that they absolutely need, which are essential for their business. Whether you guys agree with me or not, I really don't care. I'm putting this out there because this is what I'm seeing, and this is my opinion, and that's all it is.
Let me say a couple of things to that real quickly, Corey. I agree with you to a large extent. A couple of things that are maybe important to remember. I think maybe most important right now, make sure that you surround yourself with talented, licensed professionals. I can't say enough about that. There's just so many people out there giving advice. If you're jumping into investing or even just buying your first home, make sure you surround yourself with licensed professionals, both real estate agents, mortgage lenders, attorneys, CPAs, financial planners, people that can surround you. In fact, I have to say, that's one of the greatest blessings that I've had in my life is to have surrounded myself with people that know a lot more than I do in specific fields that have helped me avoid a lot of pitfalls. And so I'm huge on that. So, make sure you get good people around you that know what they're doing, that are licensed, that can help you. And just a quick note on the jumbos. The jumbos have not gone away entirely like the non-QMs have. So at least temporarily, there are still some jumbos, but like you said, much more difficult to get. So, be careful, be much more careful when you get in that jumbo realm for sure.
And then I think what I'll do is I want to quickly tell you guys about the hard money lending, the state of hard money lending. It's pretty simple, guys. Basically, a lot of the money in the market that was available to real estate investors has now gone away. And why? The majority of that money that has been funding real estate investing has been coming from private funds, hedge funds. And essentially, where are they getting their money? From the capital markets. I heard a quote yesterday on the Financial Times where someone said, and I should know who, but I'm going to just go off the cuff here. He said, we are in a capital markets crisis, not a financial crisis. And what does that mean? It means that what Blake and I were talking about at the very beginning of this call, which is that liquidity is dried up, that paper does not have buyers on that secondary market right now. And so it's in a holding pattern. And a lot of the money that has been fueling real estate investors and fix and flip investors over the last few years has been coming from large hedge funds and private funds that are funded by Wall Street. Let me give you a few names. Pure Street, Core Vest, Citadel Servicing, Sprout Financial, Temple View Capital. Okay, the list goes on and on and on. I could sit here for 24 hours and just read you the names. There's been so many of them. And all of them have temporarily closed their doors. And if they haven't, they've really, really increased their lending requirements. They've lowered their loan to values and they've increased their pricing. So for the ones that are still doing business, the loans are just not what you were being offered a month ago or 2 months ago. Now, the other side of hard money is hard money lenders like myself that are funded solely by private investors. So I don't rely on the secondary market to fund my loans, luckily, because I'm still in business and I'm still lending. But for those of us that are structured like how I'm structured, where our loans are funded by private investors, we've seen a lot of changes as well. Our investors have lowered their loan to value ratios. And so if I was able to do 100% of the purchase price before, now I can only do 90, 85, 80% of the purchase price. So real estate investors are having to bring in more money down. The other thing that we're doing now is our underwriting standards have increased. Before, these were just asset-based loans. We would look at the property and the value of that property and say, okay, this is a good deal. We can lend on this. Now, I'm requiring more documentation, and I have a lot more questions. How many deals do you have going? What are the state of your deals? How much cash do you have on hand to support these deals if you have to hold these properties for longer than you anticipate? What is your credit score? And these are questions that I never asked and a lot of hard money lenders never asked before, but now we're asking those questions. And then in my underwriting and in the underwriting of other hard money lenders that I've talked to, we're really looking at worst case scenarios. What if this happens? What if that happens? And we're presenting those questions to our borrowers to say, what are you going to do if, and let me give you some examples. You're buying a rental property that you want me to fund, and you basically have a huge vacancy rate of 60%, let's say, and of the 40% that you have, how many of them are actually paying? How much cash do you have to support that investment for how much time before you're not going to be able to make payments on this loan? On fix and flips, what am I doing? I'm looking at your after repaired value and the comps that you're using to support that on a fix and flip, for example, and I'm taking 20% right off the top, because that's our worst case scenario, folks, is that what you're betting you're going to sell that property for in 2, 3, 4, 5, 6 months, it might be 20% less than what someone sold their property for in December or November or back in July of last year, right? So, hard money lenders that are still lending, we've got more documentation requirements. We're using worst case scenarios in our underwriting. We're lowering our LTVs. And when I say that, like I said, when I used to give you 100%, maybe now I'm only going to give you 90 or 80 or 70. I mean, that's how it's changed. And then finally, the cost, which is something that I didn't mention before. For now, the 9% fix and flip loans from the likes of Lending Home and Sprout Financial, folks, that is not real anymore. And until further notice, we're not going to have that happening. So interest rates have gotten higher. And why? Because of supply and demand. He who has the gold makes the rules, right? That old phrase. So your hard money lenders that you're going to now are probably going to increase their pricing on you because they have money and other people don't, and there's a lot of demand for that money. So those are some things I wanted you guys to be aware of on the hard money lending side, in addition to what Blake shared about the traditional mortgage lending side. We want to wrap this up, you guys, so everybody can get back to their lives, but there's one other thing that I wanted to discuss with you and have Blake share his opinion on this. Blake, we talked earlier today about some of the conclusions from all this. Nobody has a crystal ball. Yeah. Nobody out there can tell us what's going to happen. Some of the biggest economists, some of the biggest real estate experts out there cannot tell us they have no clue what's going to happen because nothing like this has ever happened in history. You talked to me today about, you told me that we could see some pent up demand But then what? And I want you to explain why you think that we could have that pent up demand. And then I'd like you to go into a little bit more detail about when you told me earlier today that there's a lot of big mechanisms in place that they're very slow and they take a while to get moving again.
Yeah.
So let's finish with that. What are some of the thoughts you and opinions you have there?
Yeah, no, look, I talked to my sister who's a real estate agent in Phoenix, Arizona right now. Their market's somewhat similar to ours, always has been. And, we kind of agreed that, just like, just like I think vacation, in fact, we were teasing the other day in the office about everybody's got this pent up vacation demand, right? So I have a suspicion we've been in our houses, driving ourselves nuts for the last, 30 days, whatever. There's going to be a pent up vacation demand. Everybody's going to be on vacation, right? And we're not going to be able to get the national parks are going to open back up. We're not going to be able to get a hotel because of that. So I think there may be, some of that same, we see pent up demand that spills over into the real estate sector, at least temporarily, because of course there's a lot of people looking for places that feel that have been really shut down, right? They haven't been able to go through houses like they wanted to. They've just been, they haven't been able to go out and about because of orders or, to stay in place and shelter and all that stuff. So I do think there's going to be some pent up demand that spills over into our marketplace, whether it's vacations, vacation rentals, houses, investment properties, etc. The big question is going to be what happens after that demand kind of fades a little bit. And to your second point, which is the economy and our U.S. economy and the world economy, really is, to me, I like to think of the best metaphor I can think of is a large factory, right? Where you have all these huge cogs and gears and wheels and, and they're spinning and they're turning. And you've got these engines that are, pushing those, into action, and they're heavy and and it takes them a while to get up and running. And, in recent, months before this happened, that machinery was buzzing along and doing quite well. Once that machinery shuts down, those are big wheels to turn. And that's effectively what we've seen happen, is that these big wheels and cogs have shut down and almost come to a standstill. I mean, they're barely moving, and it takes a lot of energy, right, to get those going back again, and especially getting them back up to speed, because the wheels of economy turn slow.
Yeah.
And so I kind of see, and once again, this is my opinion. We've talked a lot about opinions because, nobody knows for sure. But I kind of see, I think that I had mentioned to you that this kind of feels like the edge of the tsunami. We're looking out over the horizon. We see a little tsunami coming in. I think the effects of the economic, the sliding of, or the starting back up of those wheels it's gonna take some time. And I think the devastation that could be caused, and by the way, I hope it's not. I certainly hope we can all go back to work soon. I hope that the economy is going to be fine. I hope it will rebound. My best hope is that, within 30 days from now, this will all be like a nightmare, and that we're through it and we're done and we move on with our lives. We all hope that. But I suspect that the wheels of the economy are going to take a lot longer to get turning. And I also suspect that the devastation that just this short shutdown has caused is still left to be seen. I think the tsunami is going to roll through, and we're going to see, we're about to see in the months to come what true economic difficulties it's caused for all of us.
Right. It's all going to come out in the wash. Everybody can make predictions about what they see, but nobody knows. Nobody knows. I think I agree with you that we're going to see a lot of pent-up demand. People are going to be in a frenzy to go on vacation again, or just get out and experience life, buy stuff, go to the shoe store and try on those sneakers that they so badly want. Buy an investment property possibly that they've been looking so hard to buy, for those that haven't lost their jobs or that have plenty of cash sitting around. But yeah, I definitely think we're going to see that. Who knows what's going to happen? I mean, we have, I was telling Blake earlier today that one of the, dun, 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 dun kind of things for me is, what's going to happen when the kids go back to school? Because we all know that the market slows down. It's a seasonal thing. As soon as the kids go back to school, most homeowners don't want to move until, spring again. And so, my personal opinion is that we're going to see, it's going to shoot up for the rest of the summer. And then as soon as the kids go back to school, I think we're just going to see a sort of flattening out. For those real estate investors that have listed their properties too late in the summer, and they're or homeowners, general homeowners, and they're getting them up after August 1st, they're going to hold those properties, in my opinion, for a while. And they are also going to have to take some price reductions to get rid of them. So that's my personal opinion. Again, as far as that goes. And I do agree with you, Blake, that, yeah, I mean, it's a big machine, and it's a big, unflexible machine that's very old and dated, and that's our economy, and that's the global economy. And to get that going again is not going to just be something where we snap our fingers and say, oh, wow, everybody can go back to work. It's going to take a little while to get that going again.
Yeah.
Well, I wanted to quickly share my screen. I wanted to put up Blake's contact information for everybody super quick. If anybody would like to get in touch with Blake, they can. You know how to reach me, Corey Dutton, Private Money Utah, privatemoneyutah.com. We're licensed under Wolf Creek Mortgage. I want everybody to know that, again, Blake and I are here as mortgage professionals, hard money lender, and these are not the opinions of the companies that we represent. These are just our personal opinions, and so please don't take these opinions as if we're the spokespeople for these companies. We're not. This is just us here having a discussion and sharing our opinions. So, Blake, thank you so much for joining us. We're going to do a follow-up call again to check in with you guys next week. So be looking out for notifications about that, and we will update you on all the changes that have occurred in the coming week when we talk then.
Cool.
All right, Blake. Thanks so much.
See you. Be well.
See you later.